Hey folks, this is Mike Zlatnik, and today's video is going to be all about the Fed cutting interest rates by half a percentage point. What does it mean for the US economy, for real estate in general, especially commercial real estate? So let me just give you some key points here. So the Fed decided to cut by half a percent now in September, and they're projecting 2 more cuts in November post-election and December. 4 more cuts the following year, and a couple more cuts afterwards. The Fed monetary policy should take the Fed target rate from 5.5% down to 3%, possibly even below. That's the current set of projections, although things will change in the future. So what's really clear is that they are satisfied with the inflation fight, and they're more concerned about the US economy, and they're trying to orchestrate soft landing. But this half a percent cut symbolizes that they're already late, and the economy is decelerating faster than they hoped for. So they're concerned about the soft landing scenario in the matter of speaking. So all that is pretty straightforward. The stock market right now is reacting as if it was expected. So the stock market is not really showing significant boom in prices, as if this was an expected cut. As far as the 10-year Treasury yield or the bond market, it's also not really moving a lot, sort of symbolizing that this half a percent cut was sort of already baked in. That's as far as just immediate reaction to the news. We'll see what happens in the future. But let's just kind of talk about what this half a percent rate cut do. Number one, as we talked about this, the bond market has already spoken, and the 10-year Treasury yield is significantly lower than the Fed funds rate. So the 10-year Treasury yield peaked in October 2023 at 5%, and it's down to about 3.6, 3.7% today, while the Fed just got 50 basis points from 5.5 to 5% Fed funds rate. So once again, the bond market is already ahead of the Fed action. Now, what the Fed action will immediately impact is the short maturity bonds or other indices that are tied to the Fed funds rate. So floating rate mortgages in real estate will see an immediate improvement. They'll essentially see interest rate cut on most of these loans that are tied to an index by 50 basis points, half a percent. This is really good news. This is very positive news for floating rate mortgage deals. All those value add deals that have current floating rate debt, they'll see significant immediate improvement. So that's very, very positive. Of course, savings accounts, money market accounts, may start paying less. The banks may cut interest rates that they're paying on deposits as a result of Fed cutting. How long will that take? We'll see. We don't know, but usually those changes do take place. Also, obviously, other loan products that are tied to the variable rate of Fed funds rate or other indexes like prime will adjust down. So the prime will likely adjust down very, very quickly by 50 basis points too. And many other indices like SOFR, secure overnight funding rate, will adjust down as well. So that's the impact, immediate help to the borrowers in commercial or other mortgages and loans that are tied to the variable floating rate debt. Next, we are obviously seeing a shift in the policy. This is a both psychological and immediate impact. So it's not going to be one rate cut, but cumulative effect of multiple rate cuts, which may improve valuations in commercial and other real estate. Now, residential is really held up at the high level of prices. How much additional help will this do for the residential market? We don't know because the prices are already high and affordability is pretty low. But of course, it'll be a positive move. In the commercial space, it is a significant positive move because valuations of commercial real estate depend on the availability and cost of financing. A lot of value-add deals borrow on a floating rate debt, and all these deals will now see 50 basis points, half a percent improvement in the cost of money when they are financed or refinanced. So commercial valuations, meaningful improvements. A lot of commercial valuations actually depend on the long-term bond rates, like a 10-year Treasury yield, which dictates long-term mortgage rates. And that's already at a meaningfully lower place. So in summary on this topic, we would expect gradual improvement in the valuations of commercial real estate assets as a result of this rate cut and a forward guidance or further rate cuts that are yet to come. Transaction volume. So transaction volume may start picking up. It's been very, very slow and low on the number of transactions in 2023 and 2024. With rates first cut being in place as well as forward guidance, it's very possible that buyers will start coming out and negotiating a little bit less hard, not looking for sort of vulture deals and just phenomenal buys, but be a little bit more open to make the deals with sellers.
So the bid and ask spread, which is pretty high now and transactions not really happening, may improve. The buyers will start bidding up to be able to buy these assets. The sellers have not been capitulating because they expected the cuts, they expected the market to improve. So we'll see what these forces, how they get together and improve transaction volume. But the general expectation, we may see some improvement in volume of the deals that will be taking place over the upcoming months and quarters. So that's the wrap. That's just a quick summary of the Fed funds rate cut and the positive news. I am personally excited. I'm very happy to see 0.5% cut. I was in the camp of a quarter cut and I was wrong. And I will happily admit I was wrong, because 0.5% cut is certainly better news than a 0.25% cut. And it'll be a lot of sort of positive energy for commercial real estate industry. By the way, a rate cut helps both equity investors and debt investors. It helps equity investors as valuations of equity improve. It helps debt investors from the point of view that if interest rates fall, the values of loans or bonds go up in general. And it lowers LTV. Loan to value ratio on loans gets better when valuations improve. So this is good news for both if you are an equity participant as well as if you're a lender. I hope this was helpful. Until the next time, thank you.